How concerning is the stock market? In this week's video, we'll review the hard evidence, and you can decide. Before we get to the charts, let's cover some basic concepts. Presently, the charts look terrible. Markets can find their footing at any time, which is why we're constantly preaching flexibility and keeping an open mind. They're requirements going into next week. At some point, support, and we'll show some support, possible support in this week's video. At some point, support will hold, but the market has to prove it to us. We won't anticipate that it might hold. In summary, risk is high until the market can prove otherwise. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Regular viewers, bear with me. We'll explain these concepts once for those that are new to the fold, and then we'll use them on numerous charts. We may move faster this week than we've ever moved before. We have a lot to cover, but the concepts are the same, so we can move quickly. These are weekly charts, and we'll show several of them this week. This is the S&P 500 in 2008. This is price here. We use these moving averages to help us discern between volatility to ignore, volatility to ignore. Why do we ignore it? Because the primary trend is still down, and volatility to respect, because now something has changed in a meaningful way relative to the trend. You'll notice this chart looks quite a bit different than this chart. A full bore bearish look, when the probability of bad things happening is high, is price below both moving averages, blue below red, and the slopes of both are down. This looks quite a bit different. Price is above both moving averages, blue is above red, and the slopes of both are up. This is 2008, a low probability period. 2009, a high probability period, and a full bore bullish look. The present day chart as of the close on Friday, October 10th, has a full bore bearish look, telling us that the probability of bad things happening is higher here than it was here. This doesn't tell us what will happen next. We want to be able to see it, this chart, to begin to morph into something that looks more like this. This is a high-risk look until proven otherwise. This chart will tell us that keeping an open mind is extremely important here. This is a long-term weekly chart of the broad NYSE composite. We've used this in our videos for quite some time. 2007, resistance here, resistance here, resistance here, a bullish breakout. What once was resistance may now act as support. You can see where we are now is a key area. Acted as resistance, resistance. It may now act as support. Acted as resistance, resistance, support. May now act as support. We easily could get a bounce in this direction. If this breakout fails and we move in this direction on a weekly basis, the probability of bad things happening will increase, because this now will be a failed breakout. What will happen next? We have no idea. We don't need to know. We just need to pay attention and continue to follow our disciplined system and rules. These are the moving averages that we've used in videos in the past. You can find videos on our website, FAQ, see the 1987 flash crash in 2008 Q&A in the FAQs. This is actually as of September 19th. You can see the S&P 500 daily is above all the moving averages, the fastest moving averages on top, the slowest moving averages on the bottom. This would be a full bore bullish look. How does it look today, and how has it changed? We've gone from a full-bore bullish look to almost a full-bore bearish look. We're still above the 200-day moving average, and there's no doubt that price could bounce off of this 200-day, but we don't anticipate that. We need to see it. These tight moving averages here tell us that we could get a big move in this direction, and it also tells us that 1970-ish, especially if these stay tight, may act as relatively strong and possible resistance. We'll keep an open mind, but this is observable deterioration. Notice here, this never rolls over, telling us that the intermediate term trend is stronger here than it was here. This period here is also stronger than this period here. This is a chart we've covered numerous times in our videos. We're looking at IWM, or small capitalization stocks, on a weekly basis. The S&P 500 is up here for reference purposes only. Small caps consolidated for 5 months here and finally broke down, helping foreshadow this decline in the S&P 500 here in black in 2011. 3 months of consolidation finally broke down, helping foreshadow this decline in the S&P 500. We have a multiple month consolidation and a bearish breakout here, and we're getting close to getting a bearish moving average crossover. In fact, we did indeed get it. All of this is telling us that from a probability perspective, risks are higher now than they were here, 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 or here. Our holdings in TLT performed well this week. In fact, they beat the S&P 500 by over 5%. If you're a client, you may be wondering, why have you not added more bonds? And why are we holding so much cash? First of all, interest rates may be rising, which would be bad for TLT, and there's some fundamental risk in the background. But more importantly, this is a very indecisive look, and not until this week has TLT relative to SPY resolved itself outside of this box. It did break out to the upside this week in favor of TLT. We have a full-bore bullish look in favor of TLT. This doesn't tell us anything about what will happen in the future. It just tells us that the probabilities are now more favorable for TLT relative to SPY on a weekly chart. We've covered this analysis in the past, but you might say the market has to right itself soon. Well, no, it doesn't. Anything can happen. The market could right itself next week and rally to new highs, or we could have a correction like one of these historical corrections. It's a handful of corrections here. The average correction took 114 calendar days. If this correction took 114 calendar days, the stock market would not bottom until January 1st of next year. The median period or length of these corrections in the S&P 500 was 87 days. If this correction were to last 87 days, the stock market would not bottom until December 15th of this year. The average decline in these corrections historically in the S&P 500 was 19.5%. If we saw a 19.5% correction, the S&P 500 would bottom at 1625. We closed Friday at 1906. Is this a prediction? No. It's just telling us that it's possible, based on history, that we could still be in the early stages of a correction. We want to conserve cash and buy back at a lower level. History tells us we might be able to buy back at a much lower level than Friday's close. We'll head into next week with an open mind. We have no idea when it will come, and we don't need to know, but we do know this for a fact: it's inevitable. 100% certainty that a new bear market will start at some point in the future. Just as a reminder to put risk management plans in place, the S&P 500 lost 58% in the financial crisis and 51% after the tech bubble burst in 2000. Going back to our original full-bore bullish and bearish look concepts, all of these charts are as of the close on Friday, October 10th. This is breadth actually as of the close on the 9th. Market breadth, full-bore bearish look. Small caps weekly, full-bore bearish look and broke support. Credit markets, JNK relative to TLT, full-bore bearish look as of the close on Friday, October 10th. Remember, we said the charts look terrible and risk is high until proven otherwise. Well, you can see it right here. Risk on versus risk off. S&P 500 relative to the VIX, full-bore bearish look. Financials were holding up well, flipped over to a full-bore bearish look from a probability perspective. And stocks relative to intermediate-term treasuries broke support, full-bore bearish look, and a new weekly low. Would I rather be long or would I rather be short? Does 2014 look more like 2008 or 2009? The answer is easy. 2008 until proven otherwise. Same question, same answer. NASDAQ as of the close on Friday, October 14th, has a full-bore bearish look that looks more like 2002 rather than this high probability period in early 2003. Same concepts and same questions. Does 2014 on a weekly basis look more like this low probability period in 1987? And those of you that say there's nothing you could have done in 1987, this chart begs to differ. Full-bore bearish look here well before a lot of the disasters happened. Not perfect, but helpful. Nothing's perfect. 1998 Dow. The present day looks a lot more like this than it does this. Are we saying 1987 is right around the corner? Absolutely, positively no. We're just saying the probability of good things happening today is lower than it was here earlier in 2014. Same question or principles. This time we're looking at would I rather be in growth-oriented stocks or conservative or defensive bonds. Does 2014 look more like 2009 or 2008? Answer, 2008. Higher risk until we see something like this. When will it happen? We have no idea. We don't need to know. We just need to pay attention and make adjustments as needed. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.